There's two underlying fundamental drivers for the economy. One is that we know there's a tremendous capex tailwind from AI. And the second is that the Fed's been on hold for 9 months, and it's kept the ISM below 50 for now 31 months, and the Fed's dovish. So that's the rest of the economy getting basically a lifeline. Those are going to be powerful tailwinds that even a government shutdown doesn't really change the story around. And now that we're in the seasonally strong fourth quarter, and valuations, I just don't think are that demanding because, NVIDIA is still at 26 times earnings. I mean, I think stocks still have a lot of upside into year end.
Everyone's focused on inflation, unemployment, and interest rates, but Bitcoin hitting a new all-time high might be showing what's really happening in the market. For 9 months straight, the Federal Reserve has held rates steady. That pause might seem minor, but it actually keeps money flowing through the system instead of draining out. This is a signal of returning liquidity, the fuel that pushes risk assets like Bitcoin and tech stocks upward. Meanwhile, corporate America is investing billions into AI, rapidly building data centers, chips, and cloud infrastructure. This surge in capital spending is sending ripples through the economy, boosting demand for energy, hardware, and software. The combination of the Fed's pause and the AI boom is pushing the market toward a new phase of growth and risk-taking. Stick around until the end of the video, where Tom Lee reveals why the final quarter of this year could spark a major market breakout.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
So the manufacturing sector has been cautious for 31 months, the longest stretch below 50 in history. And that's business confidence. It's highly correlated with earnings growth. So I think once that moves above 50, that means we're back in expansion mode, and it's good for financials and small caps, and the tech trade continues. So I think it's a broad-based rally. Well, the Fed has, I think, on balance, has to be more dovish than what they said they would be last month, because a government shutdown, as you know, disrupts economic activity. So even though they're not getting reports, there's also a standstill in GDP, and the government is a very large share of GDP. On top of that, it causes confidence to be weaker. A shutdown makes people nervous, and so the Fed will have to be even more dovish, and I think that's why stocks can rally even more than they have already. I mean, seasonality is just a base case, so things can make it different, but this year we're going into the fourth quarter where sentiment, I think, is still really muted. If you look at things like AAII net bulls, it's barely positive. After a 30% rally in stocks, historically, you'd be solidly positive on a 20-week moving average of that number. Investors have really been skeptical of this entire rally. That's why we call it the most hated V-shaped rally. Well, I think financials have also fundamental tailwinds, because we know the Fed is going to be dovish, which is helpful for economic activity. But on top of that, AI is a tool that the financials industry can leverage. It's going to help them root out fraud. It's going to help make their businesses more profitable. And it's something we've talked about at Fundstrat, which is the financials may end up getting technology valuations, especially given blockchain and moving from traditional financial rails onto blockchain and becoming more efficient. Keep in mind, Exhibit A in all this is Tether. It's the largest stablecoin issuer in the world. It's valued at $500 billion, or about 25 times earnings. It makes it the second largest bank in the world behind JP Morgan. And it shows you that by building on the blockchain, a business can really reduce cost and be a lot less employee intensive. Tether only has 300 employees compared to JP Morgan, which has 313,000 employees. Okay. So Tether's valued at around 1.8 billion per employee, JP Morgan around 2.6. Okay. So you can see the leverage coming from Ethereum.
Going from stocks to looking at the market, it's a very different skill set because there's no edge. At least I felt I had edge when I covered companies because I could, have my own sources, do my own channel checks. You can't really do that with equities, but I did that, and I would say it wasn't a great experience because that's really like when the bear market started. But we found our footing because in 2008 we wrote this report, which was called Guide to Stock Bottoms Part 1. And we still get requests for it these days because it was, what we did was we looked at every major bear market since 1918 or something. And we had detailed two things. One was that almost every major bear market is a retracement of the prior bull market. So it's not about time, it's about how much you unwind of the prior gains. And if we took 1929, the Great Depression, or the 74 bear market, those were 125% retracements of the prior bull. So you have to go unwind the entire gain and then go down even more. But just using those two prior bear markets, we said the bottom would be 670 to 720 on the S&P.
It was what, 666 or something?
Yeah,
wasn't
666. Yeah, and then there's a time like the bear is a ratio of the prior bull. So the bottom would be, the latest we said would be July 09. So that was our first sort of conclusion. Second conclusion was we listed, and this was kind of just more simple. We took like 7 metrics that you saw before bottom and the order, and it was like things like the ISM and employment. But we basically point out that like employment doesn't recover till after the bear market bottom. So things that happen before a bottom have nothing to do with fundamentals. And so we published that report in 08, but then on like February 20th, the S&P fell below whatever the minimum threshold, like it fell to 710 or something in February or not. So we turned bullish, which was of course too early, because then it went down all the way to 666. But it was close enough to the bottom that that actually really gave us a lot of visibility at JP Morgan, because we were, really one of the first people to actually believe the market had already bottomed in 09. Even as you remember, during the GFC, people thought that there was so much ghost inventory that housing wouldn't recover for decades, and we were in a new normal because rates were so low. But actually, we were just arguing that this would look like a typical bull market recovery, and in retrospect, it was. But what was interesting is that in 09, the firm was really controlled by the bond side of the business, which had a very structurally negative view about the prospects for a recovery, which of course was good for the bond side of the business anyways. And so I think that the stock market got taken over by the bond market, basically, or macro, and that made people structurally bearish for much of that recovery because the equity investor got wiped out. And I understood the importance of sentiment and how people, when in the equity world, when someone gets tired of an idea, even if they're the smartest person, they'll reach a point that just says, get me out at any price. They don't even care. And they'll never revisit the idea. And, but that's when opportunities created, So, and then around 2014, I was, things were going very well at JP Morgan, and we were in a good bull market, but I was starting to realize that if I stayed at JP Morgan, which is a great place, that was going to be my last job ever, because I was approaching, 15 years there. And as much as I think a lot of people would love the idea, I had always followed entrepreneurs and tech people. So I thought I need to think about starting my own company.
Tom Lee points out that the manufacturing sector's prolonged weakness is actually setting the stage for a strong rebound. The ISM Manufacturing Index, a key measure of business confidence, has stayed below 50 for 31 straight months. This rare stretch signals caution, but also opportunity. Lee explains that once this metric climbs back above 50, it usually marks the start of an expansion phase, driving earnings growth and lifting sectors like financials and small cap. Despite this setup, the current rally, powered by tech strength and early signs of manufacturing recovery, faces widespread skepticism, even after a 30% gain. That persistent doubt is why Lee calls it the most hated V-shaped rally. And now back to his analysis.
I left in 2014 to start Fundstrat. But it was based on a small bet, which was that I thought that the non-institutional business would come back. The recovery of equities from 2009 to 2014 was largely institutional trading. There was actually almost a dwindling or an attrition of the retail investor. And, in fact, things like Schwab, I mean, they were trading very poorly. And so I thought that the environment would return that was very akin to the 90s. So that's the bet we made when I started Fundstrat, which was really to produce institutional quality research, but try to make it available to a wider audience. So let's say you got into the 40s. There were children born during the Great Depression that were becoming adults in their 50s. And they saw how their parents lost everything because of the stock market. So from 1950 to 1960, for instance, using the Fed flow of funds data, net household allocation to equities was negative. People weren't putting new money into stocks. They were taking it out and putting it into bonds. And bonds were actually having rolling negative performance because yields went from roughly, I don't remember, like 3% starting level to almost 7% by the end of the 60s. So they were losing money in their bond portfolio.
And there was yield curve control. So this was financial repression. So they were actually losing money in real terms as well. That's
right. And so, of course, guys like Warren Buffett did famously well, but it shows you like there's a generational scar. And I think that post.com, Gen X was generationally scarred, which is why hedge funds did very well in the 2000s, but retail investors didn't buy stocks. And then, like you're saying, 2020 is when the first millennials were in their 30s. 1980, yeah. So they'd be like in their 30s by that point, and they're the ones that suddenly discovered equities.
And they discovered crypto as well, which was
yes.
At the same time. So give me your crypto story as well. Where did that come in?
Bitcoin actually had come up in several discussions when I was at JP Morgan, and John Normand, who was the head of FX at the time, had talked about it. He wrote several pieces about. He wrote one that we had a whole conversation around, our firm did, which is that he thought that Bitcoin could become a currency at some point. Now, I think the network value of Bitcoin was like 20 billion, okay? Which made it like a decent sized stock. But he was saying that it was obviously mostly for dark web and, illicit purposes. So I didn't think much of it, and I didn't even follow Bitcoin. But then we started Fundstrat. And then in 2017, I remember just for some reason, I think I saw the price of Bitcoin again. And I was like, whoa, this thing just went 10x in just a few years. And so I've covered stocks enough to know that sometimes when something does a 10x, it means there is something to it, not that it's a bubble. Like most people, I think, tend to think if something's gone up a lot, it's a bubble. But actually, in the equity world, a lot of times it's actually telling you something's real. With our not great understanding, we did spend about 4 months doing a research white paper on Bitcoin. It's exactly what you said. First, we found that if you just did a very simple two-factor model, which is the number of wallets and then activity per wallet, it explained over 90% of the rise of Bitcoin since inception.
Yeah. And it's a good approximation for Metcalfe's law. It's the best way I got of fitting Metcalfe's law to the network value.
That's right. And then, we realized that's exactly why social media networks created value. Because, I mean, the idea of like eyeballs and someone being the customer, and then because it's free and you sell them out, like that was a very new concept. So to me, I had already believed in this idea that you could create businesses digitally that didn't start with a factory. And so we published our first report on Bitcoin. It was around $1,000 though. But we said that by using the same two-factor model by 2022, it could be $25,000. And that was either saying it was going to be worth 10% of gold or the number of wallets were going to increase. I don't remember the whatever assumptions we used. And then when we published at the time, I did it more as like a thought piece. And of course, I was advocating for Bitcoin. We recommended 2%, but it wasn't something that we thought we would hang our reputation on. But it created immediate backlash for us with our institutional client, who became very angry that we were trying to pitch something that had no tangible value and was clearly just used for buying drugs. So we actually got famously fired by several well-known hedge funds. And but then I assumed we were probably onto something, because I figured if some
Yeah, that's right. When you see that reaction, it's probably right.
yeah, because if someone hates it, they haven't done the work.
Yeah.
And so so now it's almost 9 years later, eight years later. And Bitcoin's obviously done really well. It's actually had cycles. I mean, I think the story arcs are pretty bullish right now. From the shorter lens, this incoming administration, I think, is doing things that look very disruptive at the moment, but I think structurally are really positive, because it's a path for U.S. deficit to normalize. And I think, indeed, I think animal spirits are coming back, even though things like these consumer confidence reports don't show it. And we know that there is tangible drivers of productivity, including AI, in front of us, that justify, investors allocating capital. And of course, there's still plenty of disruption ahead, including crypto. And, I think Bitcoin is still our favorite idea for this year. So we think it'll be the best performing asset class, even better than gold. But I think anchoring all of this is a demographic story. I can send you some charts later, but if we look at the number of people aged 30 to 50 in the U.S., that's actually been steadily rising since 2009. It actually went positive in 2016. And what I mean by that is the number of people aged 30 to 50 matters in an economy, because they're the ones that are driving both credit consumption, but also productivity, innovation. Yeah. And then there's a contrast, because, as you know, in the rest of the world actually has a depletion of population. And so that's creating the demand for AI workers, which is what the US tech companies are producing. So I think that this does feel like it's going to be a very bullish equity cycle ahead. And that's why we're constructive. And it's been a rough start for this year, but I think we're just sort of getting through some of the kinks and burning off some of the recent bullishness.
When Tom Lee left his previous job in 2014 to start Fundstrat, his biggest bet was on the return of retail investors. Since the 2009 recovery, markets had been dominated by institutions, and platforms like Schwab struggled with low everyday investor participation. Lee believed this would change, that the market environment would shift back to something like the 1990s, when individual investors played a bigger role. That vision became Fundstrat's mission, making institutional-level research accessible to everyone. Lee also noticed how each generation carries financial scars. Those who lived through the Great Depression distrusted stocks, favoring bonds. This cautious mindset persisted through the 1950s and 60s and later shaped Gen X after the dot-com crash, when hedge funds thrived but retail stayed sidelined. By contrast, millennials in their 30s around 2020 were the first generation to embrace both equities and cryptocurrencies like Bitcoin. Lee recalls that during his time at J.P. Morgan, when Bitcoin's network value was just $20 billion, Wall Street largely dismissed it as a tool for illicit use. But after its 10x surge in 2017, his team started paying closer attention. Now the big question: what will drive Bitcoin's next move, AI-fueled growth and capital spending, or the Fed's liquidity-friendly policies? Share your thoughts in the comments. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.